Wonderful, thank you very much. And I'm going to talk the next 25 minutes or so just on what we're looking at in commodity markets at the current time. I am going to have a particular focus on China because I think it's very important in the short term. It's certainly causing a lot of dislocations at the current time. I will touch on those. Also talk about the longer term model and perhaps where some of the opportunities lie with the Chinese market. Why is China important? Well, China is the world's largest global industrial economy. Of course, it's not the world's largest economy, but from an industrial side and therefore from a commodity demand side, it is without peer, of course. And even last year, in a trade war scenario, it certainly had an impact. Global industrial production growth was the lowest since 2009. China's was the slowest since 2002. But without China, we'd have had a global industrial recession. We would have been down year on year for global industrial output. The fact that we weren't is a lot to do with that Chinese model. So, what did the trade war do? I mean, it impacted trade volumes. So look at the left-hand side there. Look, global trade went negative. It probably was recovering if we look at the December numbers, and I'll talk about some of the green shoots that were there. The December numbers were very strong. Phase 1 trade deal obviously helped sentiment. But you had this period where global trade was negative. That tends to hurt demand for metals, bulk commodities. Chinese imports that tend to be weaker at times of industrial weakness, but it's some very interesting dynamics in behind that. Who lost out in the trade war? Europe, because Europe doesn't have industrial patriotism to the same extent, and that's why we saw things like European steel demand, European copper demand down kind of 4 or 5% last year. US kind of looked after itself to a certain extent and always lags the wider industrial cycle. China did an awful lot of capital and consumer good import substitution. A lot of industrial patriotism, and with that, actually first use of many metals. We've seen this ongoing trend where first use of many metals continues to migrate to China over time. And that process did continue last year. Let's put it in context. I put it on the left-hand side there, global crude steel apparent consumption. In fact, sorry, and I've split it into two. I've split it into China, and you can see 2019 consistently above previous levels. In fact, I mean, that billion tons worth of steel, well, for certain months last year, we were above that level. Put that in context, a billion tons of steel is, of course, more than the rest of the world put together by a decent amount. And you can see in the bottom side there, I mean, ex-China was weak. In fact, Q4 was the weakest in 6 years. So we had this real dichotomy in global commodity markets. And what it meant on that right-hand side there, with the exception of aluminium, which was the odd one out, China continued to gain share in refined output as well. So this has been the ongoing model. China will buy raw materials, will have enough process capacity to process them, will export a little bit as finished goods. It's been a model that's been in place for 20 years and it shows no signs of changing at the current time. Obviously, a lot has changed in the past month, but why were things a month ago looking a lot better? We're starting to see some of these Chinese metals intensive indicators starting to pick up. Let's start with the property market. Look, I'm a commodities analyst. That means I'm a China property analyst half the time, or a China policy analyst anyway. Getting the China property market right is important because it's the single biggest consumer of metals in the world as an individual sector. And what we saw there, I mean, new starts have been positive for a while. So floor space started, good for steel, good for cement, good for the steel making raw materials. That had been doing well, but the completion side had been weak. Completion is much more important for base metal demand. That's your wiring, that's your facades, important for mineral sands demand as well. And that had really been weak. Now suddenly, in the fourth quarter, you started to see that pick up. You're now seeing a situation where developers are pushing a lot harder to complete units. And that's certainly, that pickup, in my view, is positive for demand. That's why we're looking at better demand numbers for this year. I'd also highlight on the right-hand side, look, what do we know? The global auto industry has been weak. The Chinese auto industry has also been weak. We saw 18 months effectively of negative year-on-year growth in production, but what you're seeing there is the early signs of recovery. Engines, that's basically internal combustion engines, positive year-on-year, and starting to pull wider auto production up as well. And also dealer inventories were low. We were due a restock in that Chinese auto market. So these are the kind of positive signals we were seeing. This is why a month ago now also it was coupled with the fact that we had an end to destocking, in my view, ex-China. as sentiment started to improve. So it was all looking good, but we do have to address what's happening now with the coronavirus. It probably has stalled this recovery. I'm sure many of you have been in meetings today. Not surprisingly, China stock market opened today. Construction stocks were all down 5% immediately. Copper, limit down. Iron ore down 8%. So we are having what's effectively a bit of a catch-up because obviously Western markets have been open through that period. But it's certainly causing a restriction on flow of materials at the current time. Customs is open, but getting material from the ports to the producers and the consumers, that is not happening at the current time. I put up there Hubei province itself. What its share is, it's a consumer province. So you can see it's very important for auto output. It's the largest galvanized steel producing province in China, so very important for zinc consumption. You can see there, but the consumption side is larger than the production side. So this is a net negative, if you want. What we're seeing, you're going to see a build-up, of course. I mean, you're seeing metals producers tend to continue to operate through the Chinese New Year period. Of course, consumers do not, and they have been delayed in coming back. You're seeing, in my view, it will halt the global trade recovery. Financial market position goes negative. So obviously gold gets a bit of a benefit here from the shift or the rotation away from risk. Physical markets are interesting. The molybdenum price and the vanadium price are actually up over the past 2 or 3 weeks. Now, whether that's just a blemish, but these are pure physical markets. There's no financial market overlay. And you've actually seen purchases continue to come through. I think the interesting thing to watch for is timing here. Back in 2003, there's a lot of comparisons being drawn with SARS. Now, back then, the Chinese government, once they got it under control, unleashed a fixed asset investment package we've never seen before, and we didn't see again until 2009. I do think I think growth is non-negotiable for China this year. President Xi has promised to double per capita income 2020 over 2010. This means this is the year he gets judged on. So with that, with the consumer weak, it has to go back to effectively old school fixed asset investment. The question is when. I do think there'll be a lot of infrastructure projects being pushed through. Already we're seeing local governments given the go-ahead to go and raise a lot of money in the bond market again to try and push projects through. That will come with a lag. So Q1 week, you're seeing lack of tendering. You're seeing copper smelters today announcing a lot of closures. Inventory will build and will have to be digested through the chain. But I do think into the second part of the year, actually, there'll be a bit of a reaction the other way once this stimulus package comes through. 2004 was, of course, the start, if you want, of the big commodities boom. There's a lot of arguments to be made that was actually on the back of the last big bout of fixed asset investment the Chinese government put through, what was on the back of SARS at that point. Back to the longer term. Let's talk a bit more longer term. I put up there the steel capital stock, because that's the question we always get is, when is China going to peak? When is China going to peak? Had that question my entire career. Capital stock is probably the best way of looking at it. What is installed in an economy, and that is, of course, steel going in versus scrap coming out. That's the build. And you can see there, where are we now? We are here. China's not quite there yet. You can see the US peaked around 70s, Japan peaked around, if you want, early 90s in terms of capital stock. China's getting there pretty fast. So we are now looking at the stage where that impetus from China is set to slow over the coming time, but it does still areas where we're still got a bit of catch up to do. And I would highlight, just put up the right-hand chart there, just on that's the copper intensity, if you want. That's the copper contained in the city distribution network across 10 major Chinese cities. And you can see there it's rising basically over and above the urbanization rate. So you're still seeing penetration gains come through in many areas. But this has been the story of the past 20 years, if you want. The grey bar on that left-hand chart, I put up for copper, I could put up for any commodity you want. It's China. China has been that driver of growth. That is starting to shift. Now, you look at it, actual growth has been relatively consistent for many of these things if you take it on five-year periods for 20, 25 years. But I think the makeup of that will start to shift. Obviously, we are now looking to a certain extent past China. Now, let's be absolutely clear. A delta in China will still be the biggest mover in any of these markets over the coming 10 years. But in terms of the growth, we're now looking at some of these other developing nations coming through and helping to drive that. I talked about that commodity business model earlier. Let's highlight it again. So this is the share of Chinese copper unit imports on that left-hand chart there. The bottom bar is effectively copper in concentrate. Now this makes little sense from a logistical point of view. Obviously, to minimise logistical spend, you want to be making metal as close to the mine site as possible. But that is not the Chinese model. Obviously, capital costs are cheaper. Anything that is process capacity, effectively, gets installed in China. And that, I mean, I'm talking here alumina refineries, iron ore pellet plants, anything that is processing material. So the model is to buy raw material where available. You can see the kind of lighter blue, we've got scrap and we've got refined. Scrap's an interesting one. That's a different, it's a different metric at the moment. We might talk about that in a minute. But in terms of refined, you can see that as a share continues to fall. China will probably get 2/3 of its copper in concentrate form by 2025, and will therefore be investing in areas where they can get raw materials. That's what they want access to. And I'll talk about where those are in a bit. Now, how do you disrupt that model? Well, if you get supply shocks, this is why supply shocks are tend to drive outsized commodity price reactions. Last year, it was actually the Indonesian ore ban, of course, we saw and we saw a drop in nickel imports. Even in the iron ore side, I mean, why was iron ore above $100 a tonne back in June last year, and pretty close to it recently? It was obviously the supply problems we had in iron ore post-Brumadinho. So if you get a supply shock, then it means that commodity prices are still very exposed to that, and what you will get outsized reactions. They tend, though, not to last. What's underappreciated about the Chinese model? Chinese mine supply of everything's falling. Exception of coal. Of all the commodities I cover, on a 3-year view, it's down. Why is that? Because the mining industry is not strategic. The banks won't lend to the private sector miners. And bear in mind, we had this very entrepreneurial private sector mining industry in China that used to react a lot to prices. That's gone. I say these are entrepreneurs. They go where they can borrow from the banks, and that's not mining. If you want to build a fleet of LNG trucks at the moment and truck LNG away from the ports, the banks will lend you money for that. They will not lend you money to go and open up your next zinc pit. So you've had that. The environmental hurdles, of course, are that bit higher. So you're having ever higher degrees of environmental compliance that's necessary. That's costly, and a lot of these mines were marginal anyway. So, I mean, we're now starting to see decent falls across pretty much everything in terms of that Chinese domestic mining industry. So they're going to rely more and more on imports. I've just used the example of gold there on the right-hand side. In fact, I mean, we've got 2019 figures now. That was down another 5.6% year on year. China's still the world's largest gold miner, but of course we are starting to see that fall, and that's playing into a big part to why actually it's looking increasingly like 2018 was peak gold mine supply for the foreseeable future. One of your core producers, if you want, is now heading down. Now, of course, to keep growth going, you are starting to see that Chinese gold industry look overseas more and more for acquisitions. What else is underappreciated? Well, I taught this Chinese mine supply side. I don't want to pull out my industry consultant friends, but effectively, everyone's over-optimistic still in Chinese mine supply growth. When I see a lot of models out there, I think everyone... the left-hand chart there just looks at expectations for zinc mine supply in China. They've never achieved it in the past kind of 10 years. Expectations are still that it rises quickly. I think that is overplayed, and I think that that is one area people will have to get used to. On the flip side, what we're also seeing, of course, when you put metal into an economy, it does tend to come back as scrap, depending on the commodity, of course. But we're now at that point where you're starting to see China's scrap generation accelerate. A lot of that's because, of course, China does not want to be the waste dump of the world. We've seen a lot of restrictions on material flow into China over the past 2 or 3 years. That's what we've seen on the back of that is a lot of investment in that domestic scrap generation and collection network, and therefore we are starting to see scrap come back at double-digit growth rates. The other secondary advantage of that is, of course, it reduces carbon intensity. I think there's going to be a lot of pressure, of course, on all metals and mining producers to reduce carbon intensity coming from the auto sector, coming from the construction sector. Over the coming years, the easiest and quickest way to do that is to put more secondary material back in. So actually, this is going to be a growth area, and this is one thing to watch. It does impact the requirement for primary metal across some of these industries. I would highlight there's some commodities where scrap doesn't come back. manganese, zinc, you don't get that material back. So just going to be some interesting differentials perhaps driven by that in the medium term. Can you offset China weakness? Well, you can. I mean, actually, gold bullion imports into China in Q4, I don't have it on there, will have been the lowest in 10 years. That normally you think that would be bad for a price, but of course we have seen financial market flow in that gold sector outweigh that. Gold is a macro asset allocation driven commodity now. It probably has been for a little while, whereas Indian jewelry season, Chinese physical purchases, they tend not to matter anymore. My view in gold probably slightly different to others. It's a function of assets under management. Portfolio managers, particularly at the macro asset or tactical asset allocation side, have to set a certain amount to gold. 10 years ago, that would have been owning gold equities. Now, owning physically backed gold through the ETFs is, quite frankly, for them cleaner and cheaper than it was 3-4 years ago. So actually, this is more a function of equity market performance. It makes gold less counter-cyclical than perhaps it's made out to be. But of course, it does give a general annuity to gold ETF holdings, which supports gold at a higher range than we saw in the past. Back to China. So if we're talking about long-term thematics, I mean, what are we looking at? Renewable energy, electric vehicles. They are, of course, the key areas of growth for many of commodities we look at over the coming 5 to 10 years. What's, of course, interesting, they are global thematics, let's be clear, but if anything, China's led the way in them. China's share of global renewable generation is above 30%. I've put up on the right-hand side there electric vehicle charging stations. Now, China's penetration, if you want, is still below Netherlands and Norway, but you can see where the 2030 target is. 2030 target is up there. What's interesting, the rest of the world's now following a China model. You've basically got developed world governments who have done as much as they can with from a monetary policy point of view. They're now having to go down the fiscal route, which is effectively go and do big projects, take it on the government balance sheet, and leave it for the next government to worry about. So it's interesting. Germany's come out with a target on the right-hand side, and that EV charging station, which is 4 times the Chinese target on a per capita basis by 2030. So you're now getting a bit of a race here coming through, and it's interesting to watch. That does mean that the trend I've seen for the past 15 years of developed world consumption actually falling might actually start to turn around in some of these energy transition-focused commodities. So I think that's just an area to watch. Everyone's now starting to follow that China model. Just to close off, and I do want to leave a bit of time open for Q&A, just to see some of the trends we're changing market dynamics. Look, a lot of investment in China before was in domestic markets. Now we're starting to see some overseas investments come through again in various areas. Nickel pig iron, they've had to. Again, a raw material constraint. China has no or next to no nickel resource. So what you've seen there with the Indonesian ore ban, you've seen a lot of investment in NPI supply. It's basically China annexed capacity to a certain point of view. But Indonesia now overtakes China as the world's biggest nickel pig iron producer next year on our numbers. You've also seen investment in areas, and I think bauxite is where iron ore was in 2007, 2008. Chinese units out the ground have peaked, and they're increasingly going offshore. Now, what we saw, I mean, I put it up there, 2016 imports, total bauxite imports into China, 52 million tonnes. From Guinea alone last year, 53 million tonnes. That's going to grow further with heavy investment in infrastructure. The advantage of this Guinean bauxite, it's a lot cleaner. Use about a third of the caustic soda to process that than you do for domestic material. So again, that's another area you're going to see growth and Chinese investment, and that tends to be what gets markets excited. Just a couple of things more on the export side. China's now a net copper product exporter. It was last year for the first time in history. Look, China's still copper short in terms of the raw material side, but you are getting more pressure through deflation, if you want, coming through from product exports. The other interesting one, I mean, we had yellow cake up a little bit before. Why has the uranium price not moved? Because we have had supply cuts. China's imports have actually fallen to a 10-year low, and China's now exporting enriched uranium for the first time. So with that, China's net call on that market has actually been declining for a period. It's not until that picks up that I think you start to see more price appreciation, which it should do with the reactor build we're seeing. But as of 2019, that's what was holding the price back. Couple of slides more, and then I'll open up for questions. So where do you want to see, when you're looking at a China model, well, it has to be where the risk, the supply risk is concentrated. What I put up there on the left-hand side is the number of countries supplying China with the raw material, so the ore, across many commodities. Right-hand side, think like copper, diversified risk. Left-hand side is where you start to get a bit more concentrated supply risk and a bit more propensity for supply shocks. I would argue, in a way, you could almost put a risk premium in your long-run price in those left-hand ones, because that is where there's a lot more, I say, potential that you spend more time above your long-term equilibrium than below. And the right-hand side just looks at where those key import flows are as a percentage of total. To highlight there, something like China gets 76% of its chrome ore units from South Africa at the current time. So again, concentrated supply risk. That will be an area that will be looked to be diversified probably when you were looking at strategic Chinese investment offshore over the coming period. Just the last one, I mean, on just to cover wider markets, I would highlight we're not seeing capex coming back. It's interesting, mining industry generating a fair bit of free cash flow now. Normally, compared to what we thought was going to come through in terms of growth capex, we're about 10% lower than I would have presented to you this time last year. So we're still seeing discipline, but it also means we're not seeing the growth coming through. And just as a last, that's the differentials you're seeing. And what is the differential? That's the change in the 90th percentile of the cost curve since we started pushing higher in commodity markets. The left-hand side is process capacity. Anything that's process capacity can be built bigger, quicker, and generally cheaper in China and more environmentally efficiently. And the right-hand side is where you have potential for mine output constraint. That is still what gets you more excited about commodity markets, and that is where you're getting more signs of structural cost inflation. I'll leave this up there. I'll open up the questions. It's like any analyst likes to put everything on one chart. To explain it, the y-axis is potential for short-term constraint, i.e. supply risk. The x-axis is potential for longer-term shortage. I'll leave that there, and I'll open up to any questions. Thank you very much. And I've got us back on time at least, if nothing else.
Has anyone got any questions for Colin? You know, anything about any commodities, anything he's covered so far? Anything, Bernie?
Easy.
Down there at the front. Yeah, excellent.
Hi, sorry, just with reference to this graph, why the concern about long-term chrome supply?
So chrome as a market we're basically way too reliant on South Africa. And I mean, if you want to put it, chrome can't be substituted from its main end use. Chrome is what makes stainless steel stainless. China has none, which again is generally a good thing in terms of risk for commodity market. And you can make the argument that, I mean, UG2, LG6, that's borrowing from stuff that was mined in the past. We're mining less than we're consuming, which at some point causes an issue. Now, at the moment, it's still prone to stainless steel cycles, and I would say short term, I was expecting stainless steel production to start coming back in China post the new year. Clearly, with the coronavirus, we may see a delay to that. But we're now at levels where we are when we're cutting into the cycle, which is why short-term constraint clearly isn't there. But longer term, we have to find 1 million more chrome ore units, about 1 million tons of chrome ore every year, just to balance this market, assuming a 3% stainless steel demand growth, which is not aggressive. So with that's why I like chrome in the longer term. This question.
One more down here. Yeah.
Just the relationship between steel and iron ore there is a bit perplexing.
In terms
or maybe it's not. Why are they decoupled?
Yeah, so, I mean, steel, I'm from a steel industry background. Steel refuses to admit it's a conversion business, and I mean, effectively, global steel production hasn't peaked, getting pretty close. So it's not really a growth area. Neither of them are growth markets, unfortunately. In terms of iron ore, why is it tighter in the short term? Brazil's having a nightmare, actually, at the current time. I mean, on our numbers, Vale's shipping 15 to 20% below what it should be, and that's even with lower guidance in the current quarter. I mean, it's interesting. You look at now this is mainly China related, but the freight market is now negative. The Baltic Capesize Index is now negative for the first time in quite a while. So, I mean, for iron ore, we've had a few supply constraints. Iron ore is the most efficient commodity market I cover. Price moves and supply reacts because it has to. It's a bulk commodity. There's nowhere you can go and store it efficiently, so it has to clear. For the past 2 years, we've had to encourage more iron ore on the market because steel production has been really strong, and also we've had supply problems. Last year was the first year in a long time where the three majors combined were down. Generally, it's going to be a displacement cycle. Iron ore is, of course, a longer-term threat comes from scrap coming back. I mean, let's say I model steel flat, I have to model pig iron production down 1% or so per annum. So that's why you're getting a bit of decoupling, both in the short and long term.
One more quick question down here. Yeah.
Thank you. Just a quick question. There's been a lot of talk, obviously, about China. I wonder if you just make a couple of comments maybe about India as a driver of growth. Thank you.
India, and going back to one of the charts showed earlier, I mean, India is becoming the positive delta on many of my markets in a 10-year view, the biggest positive delta. It is not going to be a China, and that it's not an industrial powerhouse of its time. So if we look at industrial powerhouses, they grow at metals consumption GDP plus for a period. India is much more an agriculture and services driven economy, so it's going to grow in line with GDP. But we're still talking 5-6% CAGR growth coming through. It's always going to be a little bit more boom and bust. It's the challenge of a democracy to a certain extent, but you're going to have strong periods, and I would say the last quarter last year was a weak period. Indian PMI though has just come out for this morning, and it's back into expansionary territory. So you're seeing signs that is starting to improve. Now, India is important for certain commodities. It's already the biggest buyer of hard coking coal in the world, and while I don't see the steel market growing, I see the Indian steel market growing. Not at the pace the government may want it to, but it is definitely going to grow. So India's always had potential. We're getting closer to the point where it's picking up, but it's still small in terms of China can move more in a month than India can move in a year. That's why I suppose the balance of the presentation was good that way. Great. Oh, my friend.
Hello. This is going to be long. The first one, Chrome at 125, 130. Why not buy now?
In terms of
I'm talking 42% South African, at 125, 130 dollars a ton. Why not buy now?
So, I mean, to me, we're at the bottom of the chrome pricing cycle. We stay here. UG2 supply just gets held back from the market. So you're seeing supply cuts on the ferrochrome side, which is partly power related, but partly price related. But you're also saying the chrome ore side. Look, this is probably not a sustainable price.
Yeah. Okay. Copper. Is it gonna go to 5,000 before it goes back up?
Good question. We saw a big sell-off. I mean, we saw a big sell-off this morning. Clearly, near-term demand expectations are being pulled back. But what's interesting, so inventory will be built over the next little while. So there's a potential it does. But at the same time, if China comes through with a stimulus package and the smelters have taken maintenance, which is what they've been announcing this morning, you don't get that inventory build that you might expect. Actually, I have a copper deficit still for this year. I do have a lot of supply coming in copper 2021 to 23, but for this year I have a deficit. I do believe it will go higher as we head into the second part of the year, assuming the virus is contained. Could it go to 5,000? It's possible. I doubt it. I think you will see Chinese support for it before that level.
Probability of China releasing a significant stimulus package in the next 3 months? 100%?
No, 80.
Thank you.
Thank you. Thank you very much, everyone.